Good morning, everyone, and a warm welcome to the Trobe Financial Investor Update Call for August. I'm Bridget Crowe, Head of Corporate Affairs at the Trobe Financial. Thank you for joining us. During today's presentation, your lines will be in listen-only mode. I'd also like to remind you that the webinar will be recorded. We had a number of questions sent to us ahead of time, and we'll try to address these questions throughout the presentation in the relevant places. We'll also take questions at the end of the presentation if time permits. To submit questions at any time during the presentation, please click on the Q&A button at the bottom of your screen. Please note that we won't be able to speak to individual account questions in this forum, but our investor team is always available to take your calls and questions on 1800 818 818. Thanks for joining us. I'll now hand over to our Chief Investment Officer, Chris Andrews.
Thank you, Bridget, and hello to all joining our August Investor Update, and welcome to you all. This month's call will continue to build on the themes that we discussed last month. Most of Australia is emerging from hibernation, but with Melbourne and sadly parts of Victoria in lockdown, it still is the tale of two Australias. Despite all of this, the big picture trend is that our national economy is continuing to progress back to a new normal. There will continue to be setbacks and bumps along the road, along the way, hence the title of today's update, but the economy is substantially better positioned than it was just a few short months ago in March and April. And it's certainly far better placed than most developed economies across the world, as we'll explore this morning. So today's call is designed to give you an overview of these themes, but also to provide a comprehensive update, as we always do, on La Trobe Financial and our credit fund. Shortly, I'll be delighted to introduce you to our Chief Operations and Risk Officer, Rowan Donoghue. Rowan will be providing a really deep examination of the management of hardship loans in our portfolio. Obviously, hardship has been a hot topic in recent months, both here at La Trobe and across the industry, so I know that you'll get a lot out of Rowan's commentary. Let's begin, as we always do, with a quick update on La Trobe Financial and our business. Repeat attendees, I'm afraid, will have heard many of these points before, so I apologise for that, but it is important that all of our customers know the strength and the quality of the business that they are dealing with. Our total addressable market is $2.5 trillion in size. That's trillion with a T. So that's the total of the $1.8 trillion residential mortgage market and the $650 billion commercial mortgage market. And if I just say by way of comparison, at the end of July this year, the value of all of the companies on the Australian Stock Exchange was just $1.9 trillion. So our market is a third again larger. It's incredibly broad and deep, and that's an important dynamic, obviously, for our investors and for our investment strategies. For us as a manager, we have 11 billion in assets under management for an incredible array of investors, everyone from the largest global investors through to the biggest banks in Australia, family offices, fund managers, and over 45,000 everyday investors, Australian and overseas, in our credit fund. This affiliation provides real-time insights into our core market. So our high-quality pipeline of new loans, around 600 million per month at present, gives a tremendous line of sight into emerging trends and themes in credit markets. Finally, we are a portfolio company of the US-based Blackstone Group, and they've got over 564 billion US in AUM globally. They've got particularly deep expertise in credit and property, and they have a relentless focus on investment discipline that's complementary to our own. So at a corporate level, we're very well placed. Our balance sheet, our profitability position, they're both very strong. We're highly liquid, and we've built a deep reservoir of trust with our investors. The leadership team are co-investors in the credit fund with some $123 million invested. Now, you would expect an organisation of our size to have a substantial team. Ours is, I truly believe, the deepest and most talented team in the sector. I've identified some of our recent senior appointments previously. So our Deputy Chief Lending Officer is David Blakely, former Chief Risk Officer of ANZ North America. Deputy Chief Investment Officer Troy Stratton has 2 decades of experience in wealth and financial services at Barclays Bank and HSBC. Our Head of Platforms and Investment Operations, Annie Sestito, she's formerly of Westpac St George and ME Bank, so she's a seasoned and experienced funds management executive and banker. Gary Bell, the former Head of Liquidity Risk at the National Australia Bank, including through the global financial crisis, a terrific asset to the team as our Chief Liquidity Officer. Our Head of Corporate Affairs, Bridget Crowe, who you heard from previously, she has over 20 years experience, including in Wall Street firms such as JP Morgan and Goldman Sachs, JB Weir. Rick Drury, the former Head of NAB's Workout and Turnaround area and of NAB's UK commercial property operation. He heads up our asset management risk team, really important part of the business, especially at this time. It's a quality team. It's a team we're committed to building on as our business grows. Recent years have seen a material improvement in the quality of assets in our portfolios. This is the result of continued and active management by our portfolio managers and credit analysts. They have an unwavering commitment to the highest standards of disciplined investment execution, and you heard from Corey Bannister on that last month. This trend has been supported by the contraction of the credit appetite of the banks in the wake of Basel III, the global banking standards imposed by Basel III, macroprudential regulation, and more recently, the Hayne Royal Commission. The chart on screen shows that in June 2016, prime and super prime assets were 28.2% of the portfolio. 4 years later, that's grown to 37%, so up 31% over that period. Similarly, the higher returning but riskier specialist assets were 19.1% in 2016. Now, we were really comfortable at that level. They've now dropped to 9%, a 50% reduction. This portfolio de-risking, it's structural and it's baked in. It will continue in the forward period, which will, of course, benefit all investors. As you'd expect, we're taking particular care to ensure high quality assets in the current environment. There's been one significant development this month that I'm really pleased to be able to talk about today. Trobe Financial has entered into a 3-year partnership with Qantas frequent flyer. Now, this partnership aims to provide even more value for investors in the Trobe Australian Credit Fund and to help you make your money work harder, even harder than it already does. Under the partnership, new eligible investments of $10,000 or more into the 12-month term account will receive 250 Qantas points for every $1,000 invested. You can see on this slide an example of some of our advertising and promotional material for the partnership. It's been really successful so far. We've had a really good pickup from this program. So for more information, please call us or head to our website. So that's the corporate side. We've got through that quickly. Let's now turn to our portfolios. And as I mentioned earlier, a key hot topic in credit at the moment is borrowers who are experiencing hardship. And who better to take us through this issue than our Chief Operations and Risk Officer, Rowan Donoghue. Rowan is a Senior Vice President with Trobe Financial. He's been with us for over a decade. He's a highly experienced corporate lawyer, brings a wealth of experience to his role, and he's overseen the hardship, workout and collections part of our business, as well as the broader legal and compliance, internal audit and risk function generally for many, many years. Hello, Rowan. Thanks for joining us.
Good morning, Chris, and good morning, everyone. Thank you very much for the warm introduction. Look, it's certainly true that borrower hardship arrangements are the hot topic at the moment within the industry, given what's occurred since March and April this year. As our investors are no doubt aware, coronavirus and the associated economic lockdowns that we saw across Australia starting in March has had an unprecedented impact on household incomes throughout Australia. And this has resulted in a large number of borrowers across the industry seeking financial hardship assistance from their lenders. Before we go into some detail around how that's impacted the credit fund portfolios, I think it's worth mentioning though, that the concept of financial hardship is not a new one. Lenders like Trobe Financial, who holds an Australian credit licence and is subject to the National Consumer Credit Protection Act provisions, are required to have arrangements in place to assist borrowers who are experiencing financial hardship. As a consequence, at any one time, we are likely to have a number of our borrowers on hardship arrangements due to the impact of natural disasters such as bushfires or floods, or personal significant life events such as significant illness or injury. So hardship arrangements are actually a very well understood and well regulated part of our industry. For us, that meant when we saw the impact of COVID-19 shutdowns in March and April, we had the existing structures and processes in place to manage customers who have been affected by those shutdowns. Of course, there was a need to deploy additional staff to deal with the higher volumes that we were seeing in the business, but those additional staff joined a team of existing specialists and were working within a framework which had been very well established over many, many years. And I think, Chris, that's been a sort of a key driver for us in terms of the success that we've had so far. First, in managing that high volume period of applications in March and April, and since then, reducing our hardship numbers to their current levels, which I think we would all consider to be fairly benign. I might now turn to the slides on your screen. You can see from this slide that La Trobe Financial devotes significant resources to risk and asset management. The Risk and Governance Division comprises 78 professionals across a range of risk-related disciplines, including a team of 58 focused on hardship and arrears management. In that hardship and arrears management space, I am assisted by our Chief Asset Management Risk Officer, Mr. Rick Drury, who Chris mentioned in his intro. Rick comes to La Trobe having spent 30 years in the industry, gaining a lot of experience in risk and asset management. As Chris mentioned, he served for many years as the head of the National Australia Bank Strategic Business Services Group, which is its primary workout division. So he's a highly experienced professional and he does tremendous work managing the collections and hardship teams for La Trobe Financial. Rick's not a sole operator in the risk and governance area. He has two very, very competent and experienced deputies in Sean Wright and Jackie Giuliani. Both of those have many decades of asset management, collections and hardship management experience. So all in all, it's a very well-resourced, competent and committed team that's overseeing this part of the business. And that's held us in very, very good stead over the past few months. Looking now at what we've seen in terms of the curing of hardship applications, we know from data published by APRA and the Australian Banking Association that all lenders experienced high levels of hardship claims through March and April this year. Economic lockdowns were announced before the key federal government stimulus measures had been put in place, and as a consequence, many borrowers, acting quite rationally, applied to their lender for hardship relief to preserve their cash flows. For us in the credit fund, that resulted in a peak of around 15% of the portfolio being subject to hardship arrangements at the peak of this period. In response, we immediately deployed additional resources to the hardship team to ensure that we could have strong one-to-one contact with each of the customers and make a very clear and strong assessment of their hardship position. That is a critical factor, I think, when we're dealing with hardship cases. You need to have the capacity to engage with your customers one-on-one to truly understand their financial position and how they've been impacted by COVID-19. At the end of March, the federal government announced its JobKeeper program. The effect on hardship applications across the industry and for La Trobe Financial was immediate. They dropped dramatically over the next month to very low levels. We got through that period of peak panic and then they've remained low ever since. And we can see on this graph what impact that's had for the credit fund. Hardship levels peaked in April, May, and have since been curing very rapidly, down to 5.4% at the end of July, which is well ahead of our expectations. In fact, we saw something in the order of 15% of our customers withdraw early from their hardship arrangements. That is, voluntarily come to us and say, I no longer require hardship assistance. I'd like to restart my repayments. And I think that's a testament to the quality and resilience of the borrowers that we have in our credit fund portfolio. It's worth probably just pausing here and noting that the nature of hardship arrangements is that they're only a bridge for the customer to get through a temporary difficult period. They're not a debt forgiveness tool, and borrowers ultimately have to make all of their repayments and interest due under the loan. So a key part of our assessment is ensuring that when we do grant hardship assistance to a borrower, we don't do it in circumstances where there isn't a clear path for the recovery of their income to pre-COVID levels by the end of the hardship period. An issue which has been exercising everyone's minds nationally, I think, is what's happening in Victoria with the health crisis here. As you would expect, we're carefully monitoring the situation with our Victorian borrowers. Pleasingly, we're seeing very few new hardship claims coming through from those customers. Rather, due to the extended lockdown, we're seeing a higher level of requests for extensions of existing hardship arrangements, which again, we're working through on a case-by-case basis. But again, when I step back and I look at the overall results and how our hardship portfolio is tracking, we're very, very pleased with the outcomes to date and the resilience of the portfolio. If I project forward, we anticipate that the significant declines in hardship accounts that we saw in June and July will now begin to taper and flatten off a little bit. We expect the remaining hardship accounts to cure at a more steady pace over the next 3 to 6 months. The guidance that we provided back in April and May, that we appeared that there would be a 2 to 3 percentage point conversion from hardship to arrears, still seems to be accurate. Turning now to the 12-month term account, part of our risk management processes involves the portfolio management team continually testing our loan to value ratio positions. This is the collateral protection that investors have for their investments in the 12-month term account. So it's a critical metric that we are very focused on at La Trobe. You can see on the screen the outcomes at the end of July for the 12-month term account. In the middle on the left, you can see the LVR position based on the original valuation. And in the middle on the right, you can see the LVR position based on a dynamic, which is a current updated valuation, with 4 months of capitalized interest added to the loan balance. I note that this second valuation measure is actually very conservative and overstates the likely LVR because it doesn't take into account borrower heads, the impact of early hardship withdrawals and shorter deferral periods less than 4 months. I think there's 2 things probably worth calling out and noting from the data on this slide. Firstly, the hardship levels for the 12-month term account have really followed those of the credit fund as a whole. We saw that very, very quick reduction in hardship levels in June and July, down to 5.7 at the end of that period. Secondly, the portfolio's low LVRs leave us well positioned to manage any borrowers who are unable to return to repayments at the end of the hardship arrangement and where a workout of that loan is required. Turning to the next slide, we can see on the left that our early experience with hardship arrangements was consistent with what was seen in the overall market. APRA has now, this is the prudential regulator for the banks, has now begun aggregating data from the banks, and we can see that hardship levels for home loans at the end of July were in the order of 11% across the industry. I think it's fair to say that our portfolios have recovered somewhat faster than what is being reported by many of our peers, and that's a very pleasing outcome. On the right-hand side of the page, you can see the portfolio split by industry sectors. The trends you're seeing there are pretty much, I think, what you would expect to see. Hardship is concentrated in the industries most severely impacted by the shutdowns, food and accommodation services and retail, and other industries, including the important construction industry, have been less impacted. Turning now to the next slide, this shows that the profile of our hardship portfolio is broadly consistent with the overall exposure of the credit fund. That is, we're not seeing any overexposure to a particular part of our portfolio or any metrics around where our hardship portfolio is sitting relative to the whole of the book that gives us cause for concern. That is probably to be expected given the broad impact that coronavirus has had across the economy. So where to from here? Well, as I've mentioned, firstly, we're seeing hardship levels reduce well ahead of expectations, and that's been very pleasing. We've had a very solid result months in July and June. Second, we're monitoring the impact of stage 4 lockdowns in Victoria, but at this stage, the impacts in terms of new hardship requests appear to be fairly benign. There's no cause for concern in our view from what we're seeing so far in Victoria. Finally, as we've been reporting, we expect that there'll be a residual 2 to 3% of borrowers whose incomes won't recover post-lockdown. We'll deal with those loans through our normal collections processes, sensitive to the borrower's circumstances, but prioritising return to investor capital as we always do. Chris, at the Risk and Governance Division, we are very pleased with the resilience that we've seen from our borrower customers during the pandemic crisis and the way that's translated into positive outcomes for our hardship program. The team is well resourced. We have a close watching brief on how the health crisis is being resolved in Victoria. There were some good numbers in the last couple of days in terms of new coronavirus cases, and hopefully that bodes well that at the end of this current 4-week period of lockdowns, we'll see some lifting of those restrictions. Finally, we remain on point and focused on working very closely with our existing hardship customers, that one-on-one contact that I've discussed before, to resolve those accounts over the coming months. Back to you, Chris.
Thank you, Rowan. As we said, hardship's been a real talking point over the last few months with lots of our investors and advisors who use our products with their clients. So we really appreciate you setting aside the time to speak with us today. And I think we've got a lot of insights on how the hardship portfolio is tracking within the context of the broader fund. So we now turn to our portfolio update. Last month, our Chief Lending Officer, Corey Bannister, gave a really detailed overview of our credit approval process, the classic 5 C's of credit that we apply to each and every loan that we put into our portfolios. I won't repeat that today, thankfully, but I will confirm that the 5C process applies to every loan that we put in our portfolios. It's time tested, and the disciplines that it embeds in our credit analysts and our loan approval processes ensures that we retain the highest standards of asset selection across all of our portfolios, institutional and in the credit fund. Our end of July portfolio report is on our website. It's freely available to all, as it always is. We do encourage all of our investors, all interested parties, to review this report regularly. It gives an incredibly detailed overview of the portfolio, including hardship levels, and it explains how our portfolio is positioned to perform through the coronavirus period. The income profile of the credit fund remains very strong. The 12-month term account headline return is at 4.5% per annum. That rate is variable. It is reviewed monthly. The graph on your screen shows the performance of $100,000 invested in October 2002 when the fund commenced its operations, and it compares it to a range of asset classes. So the dark blue line is cash, green is property securities, light blue is bonds, red is global shares, and grey is Australian shares. The thick orange line is the 12-month term account. As I said, started in October 2002, and that is its annualised returns on a monthly basis, each and every month since inception. The returns that it has delivered have been very strong, even in absolute terms across the 18-year period. Its performance is also incredibly consistent, or low in volatility, as we say in the trade. It simply keeps on performing month in and month out. That's why it presents that gently curving upward shape rather than the ups and downs of other asset classes. Now, obviously, that's an important point because it takes the question of the timing of an investment off the table. And timing can make a real difference for most asset classes. If, for example, you invested in Australian shares in 2007, you immediately incurred substantial capital losses when the global financial crisis hit. In fact, today, August 2020, your portfolio is still down by about 10%. So 13 years later, the capital value of your portfolio is still down. By contrast, our classic account, our 90-day, 12-month and 4-year accounts, they continue their flawless track record. None of these accounts has ever lost a cent of investor capital. None of them has ever missed a distribution. What's more, none of them has ever failed to pay an investor redemption at maturity. That's the performance profile we're trying to deliver for investors. So turning to our asset quality dashboard. Now, this is a selection of key metrics from our monthly portfolio report that go to the quality of the assets in your portfolio. As you can see, our portfolio average loan to value ratio is around 63%. We take a very conservative view on loan to value ratio simply because property values go up and go down. They're less volatile than equities markets, that's true, and we do grant that point, but we want a significant margin for safety in our portfolios. We like very diversified, we like very granular investments, and you can see that from the average investment size on screen. Just $537,000 in a $3.4 billion 12-month term account portfolio, for example. Experience teaches us, 7 decades of experience teaches us that smaller investments are much more robust to market volatility. We require quality borrowers, as the key credit metrics on the table show. So 92% of the borrowers in our portfolios, for example, have 0 credit events on their credit history. More about that in a moment. 91% of the portfolio is in metropolitan locations, which of course avoids the volatility that can be seen in more remote geographies. The quality of our borrowers is shown by data that we receive from Equifax. So that's the independent credit bureau that provides credit ratings and credit reports for all Australians. The data on screen from Equifax summarises the credit scores of La Trobe Financial's borrower applicants, and it does so against those of our peers. I'll make 3 quick points here. Firstly, our borrowers are objectively a very high quality cohort. You can see that from the column graph on the bottom left-hand side of your screen. That dynamic is very supportive of resilient portfolio performance. Further, the credit quality of our applicants is visibly improving over time. Witness the rise in the red line on the top left-hand side of the graph. This is, of course, external confirmation of our earlier observations about the ongoing improvement in borrower credit quality in our portfolio. So it's a consistent theme that we see emerging. Finally, the credit quality of our applicants is above the peer average. Now, that's not perhaps quite so surprising given our reputation for conservatism in our lending program. So as we heard from Corey last month, that is really deeply hardwired into our credit assessment and portfolio management selection processes. Those of you who have attended these updates over the last 3, 4, 5, 6 months will be well aware that we took our short-dated account, the classic account, to a very overweight cash position while markets were volatile. And we held that through March, through April and into May. Our classic notice account was holding, in fact, 90% cash or close to 90% through that period. Now, consistent with the guidance we've been giving to the market over the last few months, we have commenced a measured reinvestment program, but we're still sitting with overweight cash holdings in our classic account, and they're greater than 42%. We're going to continue our watching brief on this issue. Our preference is still to tilt back towards reinvestment, but to do so in a very steady and a very measured way. Our commitment to diversification is what, as we've often said, and you will have heard us say this many, many times before, diversification is the one free lunch in investment. So you can see the incredible diversification that we drive into all of our portfolios, and we do that simply as an important risk mitigant. And that's by number of loans, it's by average investment size, it's by the largest investment that we allow to accrue into portfolios, and it's also by sector. As we've seen, we saw that on a couple of pages ago, and here on this screen, the donut charts there show that we drive diversification likewise by geography. Now, Zenith Investment Partners has described the 12-month term account as the most diversified portfolio in the sector, and frankly, that's what we're aiming to deliver. We are very strong believers in the benefits of diversification, certainly from a risk management and capital protection perspective. Our processes and portfolios are subject to independent review by Australia's leading independent fund ratings agencies. Now, that's an important validation of our portfolio decisioning and also our portfolio construction methodology. So it is a useful guide for investors. Across each of those agencies, we hold the highest ratings in the sector for our various offerings. You can see all key ratings on screen. All are available on our website. We continue to grow organically in size each month, which is really pleasing to us as a manager and is also supportive for the portfolio in that it continues to drive that diversification that you've already heard is so important to us. In July, assets under management grew by about $60 million. The feedback that we continue to get from investors is that our offerings deliver income that they just can't find elsewhere in the market. Just as pleasingly, the growth that we have seen has been concentrated in our longer dated accounts. Now, this continues to improve the credit fund's average investment tenor, so it's supportive to our group and our credit fund liquidity profile. So that's the monthly portfolio report, and we are really seeing the resilience of the fund portfolio in action at the moment. So it's been really pleasing to see this over the last number of months. We turn now to the economic outlook. And as we said at the outset of the presentation, this month there are two key issues for everyone to consider and reflect upon. First, it continues to be clear that the economic impacts of the coronavirus have not been as severe as feared in early April. The economic rebound has come much more quickly than expected, and that's at least for the 74% of the economy that is non-Victorian. On the other hand, the spike of infections in Victoria has put part of that state back into lockdown and into economic hibernation. The consistent message that we've been delivering since the beginning of the economic rebound is that economies and businesses need to be preparing for further bumps in the road like this one in Victoria. The road to recovery from this pandemic is not in a straight line, and we are seeing that played out very clearly across the globe, even places like New Zealand and South Korea. What we need to do as an economy and as a society is to ensure that we continue to learn from these incidents and get better at managing them into the future. We remain of the view that our economy is transitioning from the full hibernation phase to the rebound phase of the coronavirus economic journey, bumpy journey, such that it is. The length of this transitional period will depend on the success of our governments in addressing the Victorian outbreak and also any other outbreak that occurs from time to time. Different geographies within Australia will experience the transition at different times, and some places are perhaps already moving towards the third phase, being the restructure phase, which is the longer term effort. With this transition, we're seeing increased economic activity in 3/4 of the Australian economy, the non-Victorian 3/4. High frequency data like card and spending data. Now that's really interesting. It is actually up year on year, 4, 5, 6%. It is slowing from the dramatic rebound that we saw early in the rebound phase, and we're moving to a more measured trajectory as consumers and businesses take stock of the uncertainty that lies ahead. We're expecting that economic growth will recover as the year progresses, but not, at the risk of repeating myself way too many times, not to pre-coronavirus heights. This rebound will be reflected in higher unemployment levels, for example, and that will take some time to work through. More on that in a moment. The longer term picture, though, sees the global economic realignment taking place over a number of years. Expect a focus on insourcing of key industries and diversification of external supply chains. China was already moving away from being the world's factory well before the coronavirus hit. That trend will accelerate. What we're watching for is a sign of economic nationalism that would adversely affect a trade-exposed nation like Australia. So we don't want to allow those forces to be unleashed. On screen, you can see updated projections from most of Australia's key institutions and economists. I won't go through each of them, obviously, but I will make two very simple points. First, I repeat, do not lose sight of the fact that even the most bearish economists have materially improved their projections since the dark days of early April. In all published cases, recent economic projections are materially improved on those of a few months ago. Treasury's July update, for example, saw the peak unemployment projection come in from 10% to 9.25%, as you can see on screen. However, we're also seeing a growing realisation that the recovery and restructure phase will be difficult work for economies and will take some years to work through. Our own house views remain unchanged. We note and accept that we're at the bearish end of the spectrum of economic views. In our opinion, that's a prudent place for us to be as a conservative investment and economic manager. We will talk to some of the key economic drivers in a few moments in our headwinds and tailwinds analysis, so we will return to these themes. But turning first to the property market in particular, look, it has been so far extremely resilient to the economic hibernation. Remember that Sydney and Melbourne, for example, were up by 15% and 12% coming into March 2020. Over the last 3 months, they've come down by about 2 and 3% respectively. That's an orderly decline in anyone's language. It puts property values in those cities still up by 12.1% and 8.7% annually, as you can see on screen. There are also signs that the declines are slowing across the board, excluding Melbourne. So we're in no way seeing any signs of alarming stress in property markets at this time. Sales activity continues to trend higher and is actually up year on year, which is surprising perhaps. The value declines that we are seeing are most acute in the most expensive properties. Now that's a very typical phenomenon in a declining market. It's one that is very much in line with expectations. So good consistency in data prints there. We continue to expect softness through this third quarter. Beyond that, what happens will depend primarily on the virus and on the measures imposed by governments in response to it. Overall, our early prediction of a circa 8 to 12% correction nationally still appears to us to be appropriate. To us, that represents the normal functioning of a healthy market against a volatile macro backdrop. And we certainly don't see that sort of correction presenting any sort of material issue for portfolio performance and the like. To the point I made just a moment ago about sales activity, we can see that new listings are now returning to the levels seen in 2019, although I do note that the 2019 levels were themselves quite low. We are certainly not seeing any signs of distressed selling activity in the market at this time. On screen, you can see an analysis of historical price corrections in Australia. It's useful to spend some time here to get a sense of the likely depth, the velocity and the length of time taken during these episodes. Each situation is of course unique. Each situation is subject to its own drivers and influences, but collectively, looking at prior declines helps contextualise what's going on today. And I'd make the following 3 points about this data. Firstly, and historically, national house price declines tend to gather in the 6 to 12% range. Obviously, that's not an iron law, but it does give some indication of the underlying price elasticity in the market and the degree of structural demand support for housing values. Be careful, of course, to remember that this is a national reading, so different geographies and different housing types, they'll all experience their own outcomes. Second, the length of a decline and recovery cycle can vary significantly from under a year to around 4 years. I note that for these purposes, we've bracketed the current decline in with the 2017 decline because we didn't quite recapture the 2017 peaks. I will say though that those two episodes are very clearly two distinct and individual phenomena with their own drivers and causes. Finally, you can see that the recessional conditions like 1982 to 1984, for example, and 1989 to 1993, they're not particularly correlated with the quantum of decline in housing values. They do tend to result in prolonged decline recovery cycles, however. So this is yet another reason why our governments need to focus on the restructure phase to reignite the growth engine of the Australian economy post-hibernation. In aggregate, we retain confidence in the resilience of the housing market. We continue to see an 8 to 12% decline as the likely national outcome. And frankly, as a manager, we're very comfortable in that range. We turn now to the Headwinds and Tailwinds report, in which we point to some of the key factors currently influencing economic outcomes. And the obvious headwind remains the ongoing battle against the coronavirus, and in particular, the Victorian setback. The quicker that is resolved, the lower the eventual long-term economic damage. We will not go into the political debates in this forum, and we appreciate that they are important and they are running hot at the moment. But we do make the obvious point that this battle is likely to continue for at least some months to come. The extent of the impact that phase 2 lockdowns have had on the Victorian economy can be seen through the Victorian hospitality industry, for example. And if you look at the graph on the right-hand side of your screen, you can see that very clearly. Compare Victoria's outcome with that of the other states that are working their way out of hibernation and that have their hospitality payrolls back at 80 to 90% of pre-coronavirus levels. So in a single chart, that's the impact of phase 2 lockdowns on the Victorian economy. The next headwind is the inescapable damage caused by hibernation to our economy. You can't simply turn an economy on and off without causing damage that will take some years to recover. It's not a computer. In our language, what we're talking about, that long-term recovery, that's the restructure phase that we've been talking about. On screen, you can see a graph from the Reserve Bank's August statement on monetary policy that was released on 6 August. You can see that the Reserve Bank is expecting the economic damage, at least in terms of increased unemployment, which we think is a really key measure, to persist for a number of years. In fact, its base case forecast is that unemployment and the unemployment rate will still be at 7% in December 2022, so more than 2 years from now. That should be sobering reading for us all. We also return to the slowdown in migration because that has been and remains such a key driver of Australia's economy. You know that we at La Trobe Financial believe that demographics are, to a large extent, destiny. Migration accounts for 57.5% of our population growth this century. It is central to so many key sectors of the economy, like our educational export sector, just to pick one example. This slowdown is a key headwind for the Australian economic outlook. Turning to the tailwinds, we remain of the view that the governmental and regulatory support for the economy through the hibernation phase has been critical to cushioning the worst impacts of the coronavirus, and it will continue to be so. You might recall the so-called JobKeeper cliff that some commentators were pointing to, which would occur when phase 1 of the JobKeeper was to be stopped from 27th of September, so a month and a half from now. Over the last month, the program, the JobKeeper program, has been extended in a number of ways. Payments will run until the end of March 2021. The relevant date of employment has been moved to 1 July to protect recently hired employees. These extensions have been balanced with some targeted eligibility tightening, which seems sensible. The rate of payment is being progressively scaled back, so from $1,500 per fortnight to $1,200 per fortnight, and then to $1,000 per fortnight from 4 January next year. Overall, a strong signal in the extension of this program that the federal government will continue to support the economy through the hibernation and the rebound phase. The second tailwind is employment data, and it frankly continues to support on the upside. The labour force indicators print from the Australian Bureau of Statistics last week had unemployment at 7.5%. That substantially beat consensus expectations of 7.8%. Employment growth was almost 5 times expectations. Now, in itself, this is just one print, I'll grant you that, but it comes on the back of a wealth of data that we've been discussing over previous months that have likewise beat expectations. The Australian economy continues to surprise with its resilience, as it has done, frankly, over the last 3 decades. The third tailwind is the fact that the bulk of the job losses that we have seen in the economy to date have occurred in sectors that can re-employ and redeploy quickly. So think of restaurants, hotels, bars, gyms, museums, and so on. This is scant comfort right now to those workers who are affected, but it does mean that their medium-term prospects for re-employment are strong. Now, you can see this from the graph on the left-hand side of your screen. You can also see the growing number of industries at the top of the graph who have moved into net positive employment growth numbers since March. Our financial sector, public administration, utilities, mining, they are all contributing to net employment growth, and that is significant. Just a point there too, our mining sector in particular is set to benefit from the waves of stimulus spending that are being unleashed across the world that will last for at least the next 5 to 10 years. So watch for that as a potential growth driver in the forward period. We also have our regular reminder that Australia's fiscal position remains strong relative to most of the developed world. I'm not saying that we don't face challenges there, but the world generally will be seeing an incredible expansion in government debt due to the support and stimulus measures being rolled out. We are better placed than most to absorb that. Finally, and as a bit of a bonus tailwind for the Australian economy, and that's been the $31.1 billion released early from Australia's superannuation system under the federal government's early access scheme. So you'll remember that investors are permitted to access $10,000 in each of the 2020 and 2021 financial years. As the infographic on screen shows, Average initial application amounts by the 3 million Australians who've accessed the scheme have been $7,402. 1.1 million of these Australians have made further claims for financial year 2021, and that's been at an average of $8,487. This is an incredible liquidity injection into the Australian economy. 31 billion taken from super, and household deposits with the bank have increased by $32 billion. So connect the dots there. Household liquidity is strong, and that's a significant buffer through this hibernation phase, although conversely, it may well be holding down deposit rates with our big banks who are themselves awash with money. No doubt some of this additional money has been spent on online gambling. Spending data from Ilion Alpha Beta shows that this category, along with furniture and office spending, showed the biggest surge in those phase 1 withdrawals or phase 1 early access to super. But in other cases, it will be helping families build a bridge through the hibernation period and will be spent on groceries and the like, which seems to be where most of the phase 2 redemptions have been spent. Now, some rightly raise the damage that these withdrawals could cause to the retirement savings of those affected, and certainly that point's true. But I think the balanced view here is that when we are facing a 1 in 100 year pandemic, extraordinary measures are required across the entirety of the Australian economy. So to summarise, the main driver of economic outcomes obviously remains the pandemic, and importantly, the policies put in place to control it. Our base case is unchanged from April. No stage of the recovery will be linear. There will continue to be bumps in the roads ahead, even if and when we achieve a vaccine that can be distributed widely. As we move into the rebound phase, we will recover some of the economic damage of the hibernation period, but not all. There will be underlying damage to the economy that will take some years to work through. The fundamentals of Australia's economy, however, they are intact and they are strong, and we've seen that over 3 decades. With consistent leadership, we're as well positioned as any nation in the world to meet the challenges ahead and to thrive. And that is something that's made absolutely clear by the graph on screen. Australia's real GDP outcome was among the best in the world in the March quarter when the pandemic first hit. Based on a consensus expectations of a sort of 6 to 7% economic contraction, our economy is likely to be among the most resilient in the June quarter too. The real challenge is likely to be how we perform in the September and December quarters and then ahead. And for our unemployed, who are most often our younger Australians, as we often point out, the real risk here is stagnation. That's what our governments and our societies generally need to be incredibly focused on here. So let's conclude the prepared remarks by reviewing some of the more topical issues in the sector and any impact on La Trobe Financial. So we'll work through these key issues quite quickly. First, corporate financials. We expect to be profitable, cash flow positive throughout the coronavirus period. We've got a very strong balance sheet and net asset fundamentals. We're not anticipating any rush to capital raising, really well positioned to meet any issues arising in the current environment. We've built our business as we build our portfolios to be resilient to market volatility and to the economic cycle. So the outlook here is stable. In terms of liquidity management, well, our liquidity fundamentals are strong. Assets under management are growing month on month. Our short-dated accounts remain substantially overweighted cash. Tactically, we're shifting to a reinvestment bias, and that's in line with previous guidance, but we will continue to monitor market developments very closely. We reserve the right to adapt this strategy in this tactical setting as conditions evolve. Specifically, should there be a need to increase cash holdings at any point, we continue to be well positioned to do so. Our commitment to you is that we will retain a contingent liquidity plan that provides us with plenty of flexibility, but also the ability to manage a range of market liquidity outcomes. So really good contingent funding plan there. Our track record is that we have always paid redemptions in full at maturity, and we see nothing that will change that. Again, the outlook is stable there. Turning to the official cash rate and rate settings, look, our portfolios have been resilient to cash rate decreases. Investors have been substantially shielded over extended periods. This month's adjustments are broadly reflective of what's happening in interest rate markets. The Reserve Bank is now operating the official cash rate at what it's previously described as its effective zero bound. That is the lowest rate setting that it will go to. So no further official cash rate cuts are likely at this stage. Our modelling continues to indicate that current rate settings in our credit fund are broadly at sustainable levels given the medium-term portfolio income profile, but we will of course continue to review this on a monthly basis and take account of any evolution in interest rate profiles. So a stable outlook for rates as well. Turning to borrower hardship requests, well, Rowan's given a very detailed overview this month, so I'll just quickly summarise here. The treatment of borrowers in hardship is a standardised industry-wide approach in line with our portfolio report with very clear and mature trend of improvement in borrower hardship levels. These are occurring well ahead of expectations, so very pleasing, certainly well inside the stress test scenarios that our portfolio managers were running just a few months ago in April and May. Our hardship and collections team will be working very closely with our borrowers on a one-to-one basis to establish a clear path to return to normal repayments. Indications from our assistance program is that it'll be about a 2 to 3 percentage point of borrowers who will transition to workout arrangements. Could be slightly higher or lower depending on a number of variables. We'll work very sensitively and very carefully with these borrowers, but we will of course prioritise return of capital at all times. Importantly, hardship arrangements are themselves subject to a responsible lending overlay, as Rowan said. And as he said very eloquently, they're a bridge through difficult times, not a debt forgiveness program. Arrears levels, so they remain broadly consistent with historical experiences across our portfolios. We anticipate and have been anticipating somewhat elevated levels, particularly in the more aged arrears brackets over the next few months. And that's because there will be a delay in taking some mortgagee in possession properties to sale. We'll obviously be watching those numbers very carefully, but we're not seeing or expecting to see any undue hardship there. Our collections team are, of course, really well versed with working with borrowers in difficulty and working through periods of market stress. Again, we'll be compassionate to borrowers in difficult circumstances. We will have regard to the unprecedented economic shock caused by the coronavirus, but ultimately our focus will remain properly on calling up loans where borrowers' circumstances have changed and they're unable to meet their loan obligations. And we make no apologies for that. It's in borrowers' interests as well as those of investors. Turning finally to the sector overall, and we see continued strong fundamentals across the system. The June lending indicators print from the Australian Bureau of Statistics saw new loan commitments up by 8.7% year on year for owner-occupiers. So that's impressive, but it was down by 6.1% for investors, off already quite low levels. Securitization markets have seen strong support for Australian mortgages as a thematic for global and domestic institutional investors. The safe harbour thesis, the Australian mortgage safe harbour thesis, remains very much intact in the mind of these very sophisticated investors. The Australian Office for Financial Management continued to deploy the Structured Finance Support Fund over the last month, albeit at a much slower clip than originally expected. An additional approximately $500 million was placed over the last month or so. Importantly, the SFSF has improved its first forbearance facility in the amount of $16.8 million to an individual lender. This facility, as you'll recall, was designed to provide cash flow relief for lenders in relation to borrowers on hardship arrangements related to the pandemic. At La Trobe Financial, we will continue to engage with the AOFM in relation to this facility, but as always, it will have to get over our internal strategic and economic hurdles for us to proceed with such a facility. Overall, key point is that the initial period of credit market volatility has subsided. Markets are going to remain cautious for some time, make no mistake about that, but they are certainly more settled, and that's reflecting in spreads and volumes across markets. Our banks are well capitalised and well regulated. It does seem that the lessons of the global financial crisis, higher capital levels, swift and coordinated regulatory interventions and so on, they've all been learnt and implemented well across our system. Broadly, experiences in relation to hardship loans appear to be generally consistent across the industry and are well managed. So on that note, and in the time remaining, I'll turn to Q&A. And we've got a series of questions appearing, so thank you. And we turn first to a question from Duncan about non-performing loans. A couple of questions from Duncan about non-performing loans across credit fund accounts, history, outlook and so on. Look, really relevant question in today's environment. I touched on that very briefly, so let me dive a little deeper. First, non-performing loans are, to take the 12-month term account as an example, they're 4.6%. They're 4.3% across the credit fund. That's just above what we would describe as the normal range of 2.5 to 4% that you would typically expect to see in more normal markets, but not alarmingly so. The key driver, of course, is the slowdown in property markets because of the coronavirus. We are seeing, as we predicted a few months ago, of course, an increase in our more aged arrears loans, those in the 90-day plus bracket, and that's because it takes longer to sell those properties in this market. Our newer arrears levels, though, are in line with expectations, so just 1% in the 31 to 60-day bucket, for example. So a watching brief there, but certainly no surge in new arrears and no particular cause for concern at this stage. Our 12-month term account, for example, has just 4 basis points of provisions drawn for these loans at this stage, and that's versus an investor reserve of 40 basis points. So plenty of excess coverage there. When we think about the outlook for non-performing loans, well, we return to our earlier discussion, and that was about borrowers in hardship. Our baseline expectation has been and continues to be that around 2 to 3 percentage points of our borrowers will transition from hardship arrangements to workout. Of course, this is likely to occur as some of the longer term arrears loans are worked through, so that will mitigate the net impact on portfolio arrears, I think, but it's possible that arrears could have a sort of a 5 or maybe a 6 handle at peak. Thanks, Duncan. Really good question there. We turn now to Paul, who's asked about the rates of return for the 12-month term account. Paul, as I mentioned earlier, our view is broadly stable. So current projections show that we are at about the right level of 4.5%, although I note again the return is variable and we do review it monthly. That's an important discipline for us. Perhaps to provide some context, if you can get a sense of how well investors have done in the 12-month term account by looking at its distribution rate against movements in the official cash rate over time. So 4 years ago, September 2015, the official cash rate was 2%. Now that's hard to believe right now, but it was 2%. It's now 0.25%. So that's a drop of 175 basis points or 1.75% over 4 years. The 12-month term accounts technical benchmark index, which is the Bloomberg Ausbond Bank Bill Index, that fell even further over that period by over 2%. So take that same time frame and overlay it on the 12-month term account and its distribution rate. That's come down from 5.2 to 4.5, or a reduction of just 70 basis points, or 0.7 of 1%. I think that shows how resilient the account's been to downward movements in official official cash rate movements. We've been really pleased here at La Trobe Financial to have helped to shield investors, if you like, from the worst of what has occurred in rates markets. So look, the rate's not guaranteed. It is variable across your 12-month investment term, but we do have a really strong track record of shielding investors from downward rates movements, and we're not expecting that to change into the future. Thank you to Paul. A few have asked about whether the credit fund is guaranteed. Okay, so this is a question that pops up again, and it's a really good question, and to be very, very abundantly clear about this, I hope, the answer is no, it's not guaranteed. La Trobe Financial is not a bank. We're not regulated by APRA. Our offerings are not guaranteed. Further, we've got no intention or plans to become a bank. Banks are subject to the federal government's bank deposit guarantee scheme, and unsurprisingly, their deposit rates are extremely low. In fact, they've been consistently lower than the medium-term inflation rate, which means, of course, investors who hold funds in the bank are actually losing capital value by leaving money in the bank. Our approach is fundamentally different. We're an investment fund. Our objective is to deliver consistent monthly income and to prioritise investor capital. None of our portfolios, so say again the classic notice account, the 90-day account, 12-month, 4-year, none has ever lost a cent of capital. Likewise, we've never lost a cent of capital for any of our institutional investors. That's a powerful track record and one that we are entirely focused on retaining. Jane has asked about ASIC's recent court action against Westpac and whether there are any implications for La Trobe Financial. Another great question. Thank you, Jane. So for those who haven't followed the famous Wagyu and Shiraz case, ASIC commenced action against Westpac in 2017. It alleged that Westpac had breached its responsible lending obligations, among other things, by using a statistical lending expenses index number instead of the borrower's actual living expenses in its serviceability calculator. ASIC and Westpac initially agreed on a settlement penalty of $15 million, which would have been a record. The parties were surprised. They were both surprised when the court refused to accept the settlement. So the case ran all the way to verdict, which Westpac won, and then to ASIC's appeal, which Westpac again won. Now, it's only been in the last month or so that ASIC has announced that it will not take the case to the High Court or apply for leave to go to the High Court. The narrow view of this case, of course, is that it doesn't affect us here at the Trobe Financial much at all. We use actual living expenses in our calculator. So even if ASIC had succeeded, it wouldn't really have impacted our credit processes. More broadly, though, the case does raise an important question. Do our laws strike the right balance between the duties of a lender and the duties of a borrower to act responsibly? You know, responsible lending for a lender, responsible borrowing for a borrower. And actually, by coincidence, the governor of the Reserve Bank weighed in on this issue just last week, appearing before the House of Representatives Standing Committee on Economics. Governor Lowe said to the effect that responsible lending principles in the National Consumer Credit Protection Act were very reasonable, and we entirely agree with him on that. However, he also pointed out that, well, those very simple or relatively simple legislative tests had turned into hundreds of pages of guidance, and this had to be looked at. The pendulum, perhaps in his view, had swung too far to blaming a lender if a loan goes wrong. After all, if lenders never make loans that go bad, there's probably not enough credit being extended in the system, and that's bad for the economy. So Jane, all of these are really interesting points. We entirely agree with and embrace our statutory duties to lend responsibly, but it is important that this principle doesn't become interpreted in such a way that a borrower can avoid their own responsibilities to meet their obligations under the loan. This, of course, would introduce the sort of moral hazard that caused so much difficulty in the US in the lead up and through the global financial crisis. So a tremendous issue there. Look, thanks for your question, Jane, and thank you. We've still got a few questions to get through. Unfortunately, we are out of time, so we will I'll make a commitment that we will come back to each of our questioners separately after this presentation. But for now, we are required to finish and be respectful of your time. So thank you for joining us today. Hopefully, you found it a really interesting insight into the portfolio. We, for our part, are grateful for your attendance and interest in our credit fund. It is our pleasure to be able to assist you with your investments. And I'll now pass back to Bridget to wrap up.
Thank you, Chris, and to Rowan Donoghue and to all of our attendees. Thank you once again for joining us today and for your continued interest in La Trobe Financial. Please stay safe and well, and we look forward to your company at our next monthly investor update in September. If you have any questions we didn't get to today, please contact our investment team on 1800 818 818. On behalf of all of us at La Trobe Financial, we wish you a great month ahead. Thanks very much.